Currency is a critical part of the economy and plays a crucial role in facilitating trade, commerce, and financial transactions. The concept of currency has evolved over thousands of years, transitioning from bartering systems to sophisticated financial instruments that drive modern economies. The primary purpose of currency is to serve as a medium of exchange, allowing individuals and businesses to trade goods and services without needing direct exchanges of commodities. This system has significantly enhanced economic efficiency, enabling market participants to assign specific values to products and services and conduct transactions accordingly. The earliest forms of currency date back to ancient civilizations where people engaged in barter trade. Under this system, individuals exchanged goods and services directly based on their perceived value. While barter was useful in many circumstances, it was inherently inefficient because it required a double coincidence of wants. For instance, a farmer producing grain who needed tools had to find a toolmaker willing to accept grain in exchange. This challenge led to the development of standardized mediums of exchange, such as shells, stones, and metals, which evolved into the first metal coins. Metal coins represented a significant advancement in the concept of currency. Governments and rulers began minting coins using valuable metals like gold, silver, and copper, marking them with specific designs and denominations to indicate their value. These coins became widely accepted within economies as they possessed intrinsic value based on the metal content. Over time, standardization and government backing of currency helped establish trust in the monetary system. However, carrying large amounts of coins posed challenges, leading to the development of paper money. Paper money emerged as a solution to the logistical difficulties of metal coins. Initially, governments and banks issued notes backed by precious metals, meaning holders could exchange them for gold or silver at a specified rate. This system, known as the gold standard, established stability in the financial system by linking currency value to tangible assets. However, as economies expanded and financial systems became more complex, governments gradually moved away from the gold standard, adopting fiat currency. Fiat currency is money that has value solely because a government declares it as a legal form of exchange. Unlike commodity-backed currencies, fiat currency does not have intrinsic value, but is instead based on trust and regulation. Governments and central banks manage fiat currency through monetary policies, adjusting supply, interest rates, and other financial mechanisms to maintain economic stability. Most modern economies operate using fiat currency, ensuring liquidity, controlling inflation, and fostering growth. We use fiat currency in the United States. Commodity-backed currencies are forms of money whose value is directly tied to a tangible asset, such as gold, silver, or other commodities. Historically, this system was widely used as a way to maintain economic stability and instill confidence in the financial system by linking currency value to physical resources with intrinsic worth. The most well-known example of a commodity-backed currency was the gold standard, which operated in various countries, including the United States and the United Kingdom, for much of the 19th and 20th centuries. Under the gold standard, currency could be exchanged for a fixed amount of gold, ensuring that its value was anchored to the precious metal. Commodity-backed currencies help mitigate the risks associated with fiat currencies, which derive their value solely from government regulation and public trust. By backing money with a physical asset, governments can prevent excessive inflation, as currency issuance is tied to the availability of the commodity. However, this approach also limits monetary policy flexibility, making it difficult for governments to respond to economic crises, fluctuations in demand, and financial instability. This was one of the main reasons the gold standard was abandoned in favor of fiat currencies, particularly in the 20th century. Although most modern economies use fiat currency, there are still instances where commodity-backed monetary systems exist or are being proposed. Some countries continue to maintain large reserves of gold and other commodities to support their financial stability, even if their currency is not officially pegged to a commodity. The Swiss National Bank, for instance, has historically held substantial gold reserves as a way to bolster confidence in the Swiss franc. Certain central banks and financial institutions have discussed or experimented with commodity-backed cryptocurrencies, leveraging blockchain technology to create digital assets tied to gold, silver, or other commodities. Gold-backed cryptocurrencies, such as Pax Gold and Tether Gold, allow investors to trade digital tokens linked to specific amounts of physical gold stored in vaults. These currencies aim to combine the advantages of digital assets with the perceived stability of gold-based value. In addition, certain resource-rich nations have explored commodity-backed monetary strategies to stabilize their economies. Venezuela, for instance, introduced the petro, a cryptocurrency theoretically backed by the country's oil reserves. The aim was to circumvent financial restrictions and create an alternative monetary system based on the country's natural resources. However, the petro has faced significant challenges regarding adoption, regulation, and transparency. While commodity-backed currencies offer potential benefits in terms of stability and investor confidence, they also pose challenges related to liquidity, volatility, and practical implementation. Most global economies now rely on fiat currency, giving governments greater control over monetary policy. Nevertheless, commodity-backed currencies continue to attract attention, particularly in contexts where inflation, economic uncertainty, or concerns over fiat currency systems arise. The evolution of digital finance may further influence how commodity-backed assets are integrated into future monetary systems, providing new ways to link money to tangible resources while leveraging modern financial technology. Inflation is an important consideration in currency management. Inflation occurs when the purchasing power of money declines due to rising prices of goods and services. Governments and central banks regulate inflation by adjusting interest rates, controlling money supply, and implementing fiscal policies. Deflation, on the other hand, refers to a decline in prices, which can lead to reduced economic activity and recession. Maintaining a balance between inflation and deflation is critical to ensuring economic stability. In addition to government-issued currency, digital forms of money have become increasingly prevalent in financial transactions. Digital banking, online payment platforms, and electronic transfers allow individuals and businesses to conduct transactions seamlessly. These advancements have contributed to the rise of cryptocurrencies, which operate independently of traditional banking systems. Cryptocurrencies are decentralized digital assets that use blockchain technology to validate and secure transactions. Unlike fiat currency, cryptocurrencies are not controlled by governments or central banks, and their value is determined by market dynamics, including supply, demand, and investor sentiment. Bitcoin, Ethereum, and other cryptocurrencies represent an alternative to traditional financial systems, offering benefits such as decentralization, security, and reduced transaction costs. Despite these advantages, cryptocurrencies face regulatory challenges, volatility, and adoption hurdles that impact their integration into mainstream economies. Exchange rates play a crucial role in determining the value of one currency relative to another. International trade, investment flows, and economic conditions influence currency exchange rates. Floating exchange rates, commonly used in modern economies, fluctuate based on supply and demand in global markets. Fixed exchange rate systems, in contrast, peg currency values to a specific benchmark, such as gold or another stable currency. Governments and financial institutions monitor exchange rates to maintain trade balance, manage inflation, and promote economic growth. The role of central banks in currency management is essential to financial stability. Central banks implement monetary policies that regulate money supply, interest rates, and banking systems. They act as lenders of last resort, providing liquidity to financial institutions in times of crisis. Additionally, central banks influence employment levels, investment trends, and financial stability through policy adjustments. The Federal Reserve, European Central Bank, and other central banks play critical roles in shaping global financial dynamics. Beyond government-backed currency, various payment methods have emerged to accommodate modern financial systems. Debit and credit cards, mobile payment applications, and digital wallets provide convenience, security, and efficiency in conducting transactions. The shift from physical cash to electronic payment methods reflects ongoing advancements in technology and consumer behavior. Currency underpins economic activities, enabling societies to exchange value efficiently. The evolution from barter to metal coins, paper money, and digital assets highlights the adaptability of financial systems in response to changing economic needs. As technology continues to evolve, we will become more digital, and the nature of currency will likely undergo further transformations, shaping the future of commerce and global finance. Check out our other videos to learn more about how to become financially free.